Right now, silver may not look like the most exciting asset in the market. It's relatively quiet, often overlooked, and far from the kind of price action that grabs mainstream attention. But historically, this is exactly how silver behaves before major moves. It stays calm for long periods, then reacts quickly when key conditions align. Now, it's important to stay realistic. Silver is not currently at $75, and extreme targets like $300 or $500 would require significant global economic shifts, not just normal market trends. However, that doesn't mean there isn't real potential here. There are underlying forces building that could support higher prices over time if they continue to develop. One of the biggest drivers is silver's dual role. Unlike gold, silver is both a precious metal and a critical industrial resource. It is widely used in solar panels, electric vehicles, electronics, and medical technology. As the global economy shifts toward clean energy and advanced tech, demand for silver has been steadily increasing. On the supply side, growth has been relatively limited. Much of the world's silver is produced as a byproduct of other mining operations, which makes rapid increases in supply more difficult. When you combine steady demand growth with constrained supply, it creates a setup where prices can gradually move higher, especially if demand accelerates. At the same time, the broader economic environment adds another layer to the story. High global debt, ongoing monetary policy challenges, and concerns about inflation continue to push some investors toward tangible assets like gold and silver. While silver is more volatile and less stable than gold, it has historically shown the ability to move more aggressively when momentum shifts, making it both an opportunity and a risk. When looking at silver's potential, many analysts also point to its historical behavior. Silver has often lagged behind gold in the early stages of a cycle, only to catch up rapidly once momentum builds. These catch-up phases can be sharp and fast, which is why silver sometimes attracts attention late in the move. Another commonly discussed factor is the gold to silver ratio, which measures how many ounces of silver are needed to buy 1 ounce of gold. While this ratio has been elevated in recent years, it's important to understand that it doesn't follow a fixed rule. A declining ratio could support higher silver prices, but it's not a guarantee on its own. There's also ongoing discussion about potential supply tightness. Because a significant portion of silver is used in industrial applications rather than stored, available supply can become limited under certain conditions. However, markets tend to adjust over time, so any supply pressure is usually gradual rather than sudden. For silver to move into much higher price ranges, stronger catalysts would likely be needed. These could include sustained inflation, increased industrial demand, or broader financial instability. Without these factors aligning, large price jumps are less likely to happen in a short period. Ultimately, silver sits at a unique intersection of industrial growth and monetary uncertainty. That combination gives it long-term potential, but also makes it unpredictable. For investors, the key is not to rely on hype, but to stay informed, manage risk, and understand that real opportunities often take time to fully develop. Another important piece of the puzzle is market psychology. Financial markets are not driven by fundamentals alone. Investor sentiment, narratives, and momentum all play a major role. And when a strong story begins to form around an asset like silver, it can attract new participants quickly, which may amplify price movements in a short period of time. We've seen this kind of behavior before across different markets, where rising prices draw attention, and that attention brings in more buyers, creating a feedback loop. Silver has the potential to experience similar phases, but it's important to remember that these moves can reverse just as quickly if sentiment changes. Timing is also a critical factor. The biggest price moves often happen in relatively short windows, and by the time mainstream media coverage increases, a significant portion of the move may have already occurred. This is why many experienced investors focus on preparation rather than reaction. At the same time, volatility is part of the journey. Even in strong upward trends, silver can experience sharp pullbacks that test patience and conviction. Understanding this behavior is essential for anyone considering exposure to this market. As we move further into the decade, the direction of silver will likely depend on how multiple forces evolve together: industrial demand, supply dynamics, monetary policy, and global economic conditions. If these factors align, silver could see meaningful upside, but the path will almost certainly be uneven. Looking ahead, one of the biggest variables will be how central banks respond to ongoing economic challenges. Decisions around interest rates, inflation control, and money supply can have a direct impact on investor behavior and the attractiveness of assets like silver. If inflation remains persistent or returns in stronger waves, that could increase interest in precious metals as a way to preserve purchasing power. On the other hand, if interest rates stay high and currencies remain strong, silver could face pressure or move sideways for extended periods. Geopolitical factors also play a role. Global tensions, trade disruptions, or supply chain issues can create uncertainty in financial markets, which sometimes pushes investors toward alternative assets. At the same time, these disruptions can also affect industrial demand, making the overall impact on silver more complex. Another key trend to watch is the continued expansion of renewable energy and electrification. As more countries invest in solar infrastructure and electric vehicles, silver's role in these technologies could support long-term demand growth. However, technological changes or efficiency improvements could also influence how much silver is actually needed over time. In the end, silver's future isn't tied to a single narrative. It's shaped by a combination of economic, industrial, and psychological factors. Understanding how these forces interact is far more valuable than focusing on any one prediction, no matter how compelling it may sound. As more investors begin to notice these trends, participation in the silver market could gradually increase. This doesn't happen all at once. It often starts slowly, with informed investors positioning early, followed by broader interest as the narrative gains traction. Institutional involvement is another factor to consider. While silver doesn't receive the same level of attention as gold from central banks, larger financial players can still influence price movements when they begin allocating capital based on macroeconomic trends and supply-demand dynamics. However, it's important to separate opportunity from certainty. Silver has strong arguments in its favor, but it also comes with risks. Market conditions can change, demand expectations can shift, and external factors like policy decisions or economic slowdowns can alter the trajectory. That's why a balanced perspective matters. Instead of focusing only on extreme price targets, it's more useful to think in terms of scenarios. What happens if conditions improve? What happens if they weaken? And how silver might respond in each case. In the end, silver is not just a trade. It's part of a broader economic story that is still unfolding. Whether it delivers moderate gains or more significant upside will depend on how the coming years shape the global financial and industrial landscape. Another layer worth understanding is that silver often behaves differently from traditional investments like stocks or bonds. It can remain range-bound for long periods, which tests patience, but when major macro shifts occur, it can also react more sharply than many expect. This is why many analysts describe silver as a high beta asset relative to gold. In simple terms, when sentiment turns positive for precious metals, silver can outperform, but when sentiment weakens, it can also decline faster. It's also important to recognize that long-term price targets should always be treated as scenarios, not predictions. Numbers like $100, $200 or higher are often used to illustrate what could happen under extreme conditions, not what is guaranteed to happen under normal market behavior. The real value in studying silver is not just in price speculation, but in understanding the broader system around it, how currency strength, industrial growth, and investor psychology interact over time. These forces tend to unfold slowly, but their impact can become very visible during major market cycles. Another factor that often gets overlooked is the role of the US dollar. Silver, like most commodities, is priced in dollars, which means its price can be influenced by currency strength. When the dollar weakens, silver can become more attractive globally, potentially supporting higher prices. On the other hand, a strong dollar can act as a headwind. Interest rates are also a key variable. Higher interest rates tend to reduce the appeal of non-yielding assets like silver, as investors can earn returns elsewhere. But if rates begin to stabilize or decline, the dynamic can shift, making precious metals more attractive again. It's also worth considering how technological advancements could impact silver demand. While current trends support higher usage, especially in renewable energy, innovation can sometimes reduce the amount of silver needed per application. This means demand growth is not always a straight line upward. Market liquidity and accessibility have improved in recent years as well. With easier access through digital platforms and investment products, more participants can enter the silver market than ever before. This can increase both upward momentum and downside volatility depending on sentiment. All of these factors reinforce one idea. Silver is influenced by multiple moving parts at the same time. Understanding how these elements interact can provide a clearer perspective than relying on any single bullish or bearish argument alone. So, rather than focusing on a single outcome, a more realistic approach is to stay aware of the conditions that could support or limit silver's performance and let the market reveal its direction over time instead of forcing a narrative too early. As we close this discussion, the most important takeaway is not a specific price target, it's awareness. Silver sits in a unique position in the global economy, influenced by both industrial demand and financial conditions, and those forces continue to evolve over time. Whether silver moves higher, stays range-bound, or experiences volatility along the way will depend on how these macro factors develop. What matters most is staying informed, understanding the risks, and avoiding emotional decision-making based on hype or fear. No market moves in a straight line, and silver is no exception. There will be cycles, corrections, and periods where nothing seems to happen at all, but those long, quiet phases are often where preparation matters most. If you follow this far, you now have a clearer picture of both the opportunity and the uncertainty around silver. The goal isn't to predict the exact outcome, it's to understand the forces that could shape it. If you found this breakdown helpful, subscribe to Metal Market Insight for more clear, research-based analysis on silver, gold, and global markets. And share your thoughts in the comments. Do you see silver as a long-term opportunity, or do you think the market will stay limited in range? Your perspective helps keep this conversation grounded and real.